Hello visionaries, welcome or welcome back to my channel. My name is Marisa Talbert. I am the founder and CEO of Talbert Law Office, your favorite go-to legal resource for all things business, nonprofit, and intellectual property law. So I released a video on how to borrow money from your LLC, and I received quite a bit of interest around the topic of how to borrow money from your corporation. So here it is. In this video, I will discuss both the S and C corporations. So let's jump right into it. So let's start by explaining a few terms. The first one is a shareholder. If you are the owner of a corporation, then you are considered a shareholder, which means you own shares or stock in the company. The next term is capital contribution, which is the amount of money that a shareholder has invested or contributed to the corporation in exchange for that ownership or that stock. And the last term is a shareholder or a stock basis. It's the measure of economic interest that a shareholder has specifically in an S corporation. Essentially, the shareholder basis is the initial capital contribution, which can change from year to year. I'll talk about this shareholder basis a little bit later in this video, so stick around. So there are three ways that you can receive money from your corporation. The first way is through wages or a salary as an employee. These funds are taxable, which means you will be required to pay taxes on your wages or on the salary that you earn as an employee of your corporation. The second way is through a distribution as an owner or as a shareholder. These funds are also taxable. When you receive a distribution from your corporation as an owner, you will pay taxes on those funds. And the last way is through a loan, which is not taxable, which means that if you take out a loan in any general capacity, but definitely from your business, you will not be taxed on that because the intent of the loan is for you to pay it back. So it is not perceived as you receiving some type of benefit or some type of income. So that just helps us set the foundation. So essentially, a shareholder loan is like any other loan. The corporation, which is a separate legal entity, loans money to the shareholder or the business owner. And there are several reasons why taking out a loan from your own business can be much more advantageous than taking out a traditional loan from a bank or another financial institution. Number one, it's a great option for a short-term cash flow need. Number two, you can access the funds much more quickly than you can with a bank loan. And number three, it doesn't have to impact your credit by increasing your debt ratio. Unlike in an LLC where general formalities are optional but a good practice, in a corporation, corporate formalities are required, such as meeting minutes. So my first recommendation is that you draft valid corporate meeting minutes to document the authorization of your loan, even if you are the only owner. This just helps with your paper trail in the future. And of course, just like with any other loan, you should have a loan agreement that details the loan amount, repayment terms, interest, and any other relevant conditions of the loan. As I mentioned in the other video, without the proper documentation and repayment terms, then the IRS or your local state tax authorities could reclassify your loan as a salary or a dividend, which then makes it taxable income. So just be careful about that. It's also important to know that a shareholder's loan must be paid back within 1 year of the corporation's end of the fiscal year. Otherwise, the money will be added to your personal income taxes. You'll have to report them when you file your taxes, and then you will be required to pay taxes on those funds. For example, if you borrow $10,000 from your corporation in the year of 2023, and let's say that your corporation's year ends December 31st, 2023, then you'd have until December 31st, 2024 to pay that loan back. If for some reason you were unable to pay the full amount back by December 31st of 2024, then the remaining amount that was unpaid on the loan would then be included as your personal income. And then you'd be reporting that on your 2023 taxes, and you'd be paying taxes on that unpaid amount. There are a few other questions that the IRS may use to determine whether your loan is a genuine loan or if it's just a dividend or extra income as a salary. The first question is, are you receiving a salary that is standard for the work in your industry? The second question is the loan that you've taken out from your corporation repayable based on your salary? Number 3 is, are you receiving dividends from your company? And number 4, is the loan comparable to the profits that your corporation is making? After looking at these factors, the IRS does have the ability to reclassify your loan again as either a distribution or as salary. And if this happens, then this loan will not be deductible to your corporation. Now, I want to quickly circle back to the shareholder basis that I talked about earlier, which is specific again to the S corporation. As I mentioned, the shareholder basis is essentially the initial contribution that a shareholder makes to own or purchase ownership in the company. If you've only contributed sweat equity into your business, this may play a role in how much you can borrow from your S corporation. Think about it this way. Your shareholder basis is like your own personal shareholder bank account within your corporation. The business should be keeping a ledger of every shareholder and their shareholder basis based on what they contribute and what they take from the corporation at all times. Now, if we look at it in terms of the loan, in the same way, if your S corporation loans you money as a shareholder, then the money that you are loaned cannot exceed your shareholder basis or your shareholder bank account, or else you'll go into overdraft. And when you go into overdraft, that overdraft amount is automatically seen as a taxable gain or a taxable benefit. So you are taxed on it automatically. I hope that's making sense. Let's explain it with some numbers. Let's say you contribute $10,000 to the startup phase of your S corporation. And then 2 years later, your company makes a profit. You receive a $1,000 distribution from your corporation. Now your shareholder basis is at $9,000. We have the $10,000 that you contributed, and then we have the $1,000 distribution, which makes your shareholder basis $9,000. So now the $9,000 is like your line of credit within the corporation. And you're not going to be taxed on that line of credit because it's not considered income. This is just money that you're playing with. You repay it back, you take it out, you repay it back to the corporation. It's never really yours to keep. And so the IRS is not going to tax you on that money if you take it out as a loan. Now, let's say you need to take out a $12,000 loan from the corporation, but you only have $9,000. That overage, you went into overdraft of $3,000 by taking out that $12,000 loan. You're going to automatically be taxed on that $3,000 because you've now exceeded your shareholder basis and you've gone into overdraft. So the IRS is going to say that extra $3,000 that you took that you did not have in your account, that is a income benefit to you. And they're going to automatically tax that, even if they don't automatically tax the other $9,000 because that was your line of credit. That's probably the best way that I can explain that. I hope that's not confusing. So just to reemphasize, maintaining an accurate accounting of your shareholder basis is crucial because it affects a shareholder's tax liability and it affects how much you can borrow from your corporation. You got me? With that in mind, let's go over the simple ways to keep everything above board when you're borrowing from either your S or your C corporation. Number 1, as I already mentioned, make sure that you draft valid meeting minutes to document the authorization of the loan to you as a shareholder. Yes, even if you are the only owner of your business. Number 2, make sure that you have a valid loan agreement. Just like with any other loan, your loan agreement should detail the amount of the loan, the repayment terms, any collateral that will be used, the interest rate that you are charging, and any other relevant details about this loan. Number 3, charge a reasonable interest rate. Make sure that the interest rate is in line with the market rates to avoid scrutiny from tax authorities. Now, your interest rate does not have to be as high as what a bank would charge, but it should also not be 0. Number 4, repay your loan in accordance with the repayment terms. If you start skipping payments, then again, the IRS can reclassify that loan as income, and then you will be required to pay taxes on those amounts that is classified as income. For the corporation itself, the tax implications are going to be pretty similar to a traditional loan. Any interest paid on the shareholder loan is a tax-deductible expense for the corporation. And at the end of that year, the corporation should provide the shareholder with the Form 1099 INT, which shows the total amount of interest paid during that year. And for the shareholder, as I mentioned before, any amounts paid toward the principal of the loan are not considered as personal income, and so that will not be taxed. However, you must use that 1099 INT form that the corporation will provide to you and report that on your taxes for the amount of interest that you've paid toward the loan. And last but not least, number 5, do not be afraid to consult with a tax professional. Get the help that you need, the professional help that you need, so that you are not caught off guard with tax liabilities that you did not expect because you didn't follow a step or you didn't understand something as it relates to a shareholder loan from your corporation. And that's all I have for this video. I hope it was not confusing. Please leave me your questions in the comments and I will answer those as best as I can. Don't forget to like, share, and subscribe if you haven't already. Also, don't forget to share with a friend. And as always, this is Talbert Law Office, your favorite go-to legal resource for all things business, nonprofit, and intellectual property law. And I'll see you in the next video. Bye.
I done made it this far. I'ma keep it pushing, yeah.